Oh, right. Today is Friday, July 22nd, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. It's a Friday night special, although by the time the video is out, it's probably going to be Saturday in the morning in most regions. But stop crying and complaining already and get it together, because you're going to need the complaining and crying in a minute. So save that for later on, because the macroeconomics discussion that we have tonight is a little bit scary. And by scary, I mean realistic. Anyhow, I'd like to start the show by addressing the critically important news that we got this week about the health of the President of the United States. Take a look.
And guess what? The first frost, you know what was happening? You had to put on your windshield wipers to get literally the oil slick off the window. That's why I and so damn many other people I grew up have cancer. And why can't, for the longest time, Delaware had the highest cancer rate in the nation.
Oh, I'm sorry, that was a gaffe when he just casually announced that he has cancer. But he actually has the thing. And while being a critic of the Biden administration, I wish him a speedy recovery, and I hope that he's going to feel better soon, get back on his feet, and kick on all cylinders. Not the pedals, though, because last time around that did not end up pretty good. But why am I wishing President Biden a speedy recovery and talking nice about him? Well, maybe because he's the president, he's the captain of the ship, or maybe because the alternative is a lot scarier. Warning, if you have sensitive ears, you might want to turn the volume down a notch.
Poor hubby. Poor hubby.
Not.
He knows how to sell right there. Okay.
Okay. So joining us. Maybe.
Now, I'd like to smoke hash with her, but I'm not sure that I want her to be my president. But in case Kamala Harris becomes president for whatever reason, you might want to buy call options on ear, nose, and throat doctors, because that's going to be hot business. The amount of ear damage the American people have to endure will be tremendous. Anyways, we covered a lot here, but we still have more. We haven't even started yet, so let's do that, and here it is, in focus tonight. A rude awakening. For who? For the deniers. The people who continue to say that, oh, you're just exaggerating, you're being too negative, the economy is going to be fine. Look at the consumer. The consumer is so strong. Everybody's splurging and traveling and buying shit. How do you say that the economy is going to dip into a recession? You're in for a rude awakening. And I'm going to expose to you the whole myth of the strong consumer. Stick around. Let's start by talking about the booming economy that we all hear about. Booming economy. I actually call it the kabooming economy. For example, this week we got leading economic indicators pointing to a recession late this year. There you go. Here's your booming economy. Somehow leading economic indicators are collapsing in the so-called booming economy. On top of that, this week we got the Philly Fed Manufacturing Index. What a disaster that was. Look at this. Does this look to you as economic expansion ahead, or does it look like holy shit we're going down? Because last time we've seen this kind of dive down in the Philly Fed Manufacturing Index, it was prior to the great financial crisis and the crash in 2020. Back then, we had the Fed to the rescue. This time around, the Fed will be nowhere to be found because we have inflation and the Fed doesn't have the same amount of ammo. When we dig into the details of the Philly Fed Manufacturing Index, look at this. When we talk about new orders, only 12% of those answering the survey said that they're seeing increase in new orders versus almost 37% who said no increase. Actually, we saw a decrease in new orders. Meanwhile, a stunning majority, 55.6%, indicated the prices paid actually went higher month over month versus only 3.4% who said prices went down month over month. Likewise, when we talk about prices received, 36.5% say prices went higher month over month versus only 6.1% who say prices went down. What does that mean? You have new orders going down month over month while prices continue to move higher. We have stagflation in the economy. The next step will be a recession. And if that was not enough, today we got absolutely stunning, unbelievable piece of data. The flash PMI was not just a miss, it was a miss by a lot. And it now points to a deterioration of the U.S. economy. What are they talking about? Here's the commentary from Chris Williamson, the chief economist at the S&P Global Market Intelligence. He says the preliminary PMI data for July point to a worrying deterioration in the economy. Excluding pandemic lockdown months, output is falling at a rate not seen since 2009. Da-da-da-da. Amid the global financial crisis, with the survey data indicative of a GDP falling at an annualized rate of approximately 1%, manufacturing has stalled and the services sector rebound from the pandemic has gone into reverse. As the tailwind of pent-up demand has been overcome by the rising cost of living, higher interest rates, and growing gloom about the economic outlook. An increased rate of order book deterioration, with backlogs of work dropping sharply in July, reflects an excess of operating capacity relative to demand growth and points out to output across both manufacturing and services being cut back further in coming months unless demand revives. What does that mean? We talked about this point numerous times in this channel. The geniuses who thought that the solution to this inflation is to ramp up the supply chain, they're now finding themselves into a massive deep hole because they responded to out-of-whack demand, unrealistic demand that was off the charts, fueled by stimmies and insane money printing. It was an unsustainable level of demand. The supply takes time till it hits the market, but it's now responding to demand that is not even here, a demand that is going down. So we're seeing problems such as in Target, for example, saying, hey, we have an excess of inventories right now, and the demand suddenly dropped. So our margins will go down because we have to eat a loss on that inventory. Continuing. However, with companies' expectations of future growth slumping to the lowest since the early days of the pandemic, any such revival is not being anticipated. Instead, firms are already reassessing their production of workforce needs, resulting in slower employment growth. Da-da-da-da. And here was Chris Williamson's attempt to put a lipstick on a pig. Although supply constraints remain problematic, constraining economic activity, the weakening demand environment has helped to alleviate inflationary pressures. Average prices charged for goods and services consequently rose at a much reduced rate in July. The rate of inflation still running high by historical standards, but now down to a 16-month low to provide some much-needed good news amid the ongoing cost of living crisis. Here's the problem. Is inflation going down for the good reasons or for the bad reasons? The guy just told you. Inflation is going down because demand is all of a sudden disappearing, meaning inflation is going down for the wrong reasons, for the recessionary force that is creeping into this economy. And when he talks about slower employment, it's not only that. We're also seeing higher unemployment in the economy. Unemployment is rising slowly but surely, higher, little by little by little. Are you going to see that surge of unemployment coming around the corner? Take a look.
Right back over to Steve Leisman. He's got some economic data that just hit the wires. Steve, what are you seeing?
Jobless claims coming in more than expected, Becky, topping that 250 mark that now I guess raises some questions about the extent to which we have some real weakness in the job market. Now, this is going to be a test of the idea of all of these job openings. You could imagine, given what's happening in the economy right now, that there are some layoffs in one sector, and yet this idea that there is all of these unfilled jobs out there might suggest that over a very relatively quick period of time, these workers would be picked up and find jobs elsewhere. We don't know that, but you can imagine there could be a spike, and it wouldn't necessarily portend things going particularly bad in the job market, given the number of job openings, pardon me, and how tight it's been.
And of course, Steve Leisman is trying to put a lipstick on a pig, saying, hey, all of these people who are losing their jobs right now, they will find a job easily because we have more job openings than there are unemployed folks. We have 2 jobs for each unemployed. Here's my hunch. Sooner or later, we will find out that that number is a fugazi, the job openings number. Maybe the double counting or something funny is going on. Does anybody really believe that we have 2 jobs open for each unemployed person? Of course not. And it's about to get a lot worse. You better hope that Steve Leisman is right, because here's the shocking news that we got this week from Ford. Ford is preparing to cut as many as 8,000 jobs in the coming weeks as the automaker tries to boost profits to fund its push into the electric vehicle market. Two things here. Number one, their profits are down, the economy is deteriorating, and their margins absolutely suck. I used to be a shareholder of Ford, by the way, not anymore. The strategy's all over the place. Now, all of a sudden, they have to cut costs, and the easiest way to do that is to fire employees. And they're getting rid of over 8,000 employees. That is a massive number for one company. But another part contributing to this massive wave of layoffs in Ford is the EV lunacy, the insanity by the greenies of this rush into EVs. When they did that, it was absolutely misguided. They decided to phase out all of these assembly lines for combustion engines because they have targets. They have to get rid of all of these cars and go all in into EVs. So they shut down the factories to make them into EV factories. Okay. In the meantime, where is the supply? The consumer need cars. Where are they going to get cars? Oh, the EVs are coming. Here's the problem. When all of these companies all of a sudden rushing together to build EVs, what is that going to do? Supply shortages, mainly in EV batteries. We have a shortage of lithium, a shortage of nickel, cobalt, aluminum, zinc, copper, graphite, and the list goes on and on and on. Not because these resources are not ample on the planet, but because we have all of a sudden a massive shock increase in demand. All of these car manufacturers, American, European, Chinese, they all want to build EVs. Meanwhile, we haven't developed lithium mines or nickel mines enough to produce the resources needed for these batteries. And that resulted in lithium prices, all of these materials, to shoot up significantly higher. So we have two problems now due to the EV lunacy. Number one, there was a shortage of new cars, and these EVs that they promised us, they're not even here. Number two, because of the EV lunacy, the prices of EVs shot up significantly higher. The average right now sits at around $60,000, if not even more. The average household income is $60,000, if not less. How the hell are they going to afford these EVs? And the shortage of new cars in the market is causing used cars prices to move significantly higher, pushing inflation higher, and the consumer has no other choice but to buy a shitty used car, paying more for that car than it was new. But of course, your beloved politicians and leaders, they don't even care. This is part of their agenda. They want you to experience pain at the pump because, according to their genius plan, this will increase the demand in EVs. People will adopt EVs faster, and all the prices magically will go down at some point, and this will save the planet. Take a look at your beloved Transportation Secretary, Mayor Pete Buttigieg.
On a different tack, I looked at the F-150 you said, both the electric and the gas-powered one, and there's a difference of about $20,000 between one and the other. And when you look at the $20,000, if you estimate about 20 miles a gallon, it's going to take about, at today's prices, it takes about 80,000 miles in order for you to break even. I'm not even talking about charging costs. I'm just talking, no charging costs. And so if you actually put that down to about $2.50 a gallon, which was, the price of gas, before the Biden administration, that you don't break even until about 160,000 miles. Is the Biden administration actively pursuing high energy prices in order to force Americans into electric vehicles?
Of course not. And I also want to emphasize that you don't have to wait that 80,000 or 160,000 miles or however many it would be to break even if you don't pay for the vehicle in cash, right? The great thing about an auto loan is you can realize or lease, is you can realize the savings in terms of less maintenance and less fuel, even while the initial car payment might be higher, right? And so you're coming out ahead right out of the gate instead of having to wait many years for a payback, unless, of course, you are buying the vehicle in cash.
No, you can. I mean, your finance costs are going to be, depends if you lease it, et cetera. But the finance, at the end of the day, you're going to be paying $20,000 more, however you cut it, at least. And actually, if you finance it, you're going to pay more because you're going to be paying interest. All right. So at the end of the day, again, you're going to take either 80 at $5 a gallon, it's 80,000 miles to break even. And then, by the way, have you figured in the 10-year lifespan of a battery that you have to change? So if you have 160...
Yes, we have. I mean, the estimates that are showing that this is reaching parity and pointing toward a savings, depending on the model, do account for things like that.
But you would agree that the higher the price of gas, then the faster you reach that parity.
Of course, the more pain we are all experiencing from the high price of gas, the more benefit there is for those who can access electric vehicles. It's why we're hoping you and your colleagues might reconsider opposing the reduction of EV upfront prices with tax credits.
So you're saying the more pain we have, the more benefit we're going to get.
Of course.
I think that's what I heard you say. You said the more pain that we
Really,
have.
that's what you heard me say?
That's what I heard you say.
I know you
The more
want me
pain
to
we
say it
have.
so bad, but
Okay.
honestly, sir, what we're saying is that we could have no pain at all by making EVs cheaper for everybody, and we'd love to have your support on that.
EVs cheaper by subsidizing them, or
Yes, that's part of it.
yeah, but that doesn't make it cheaper. That means
Well, actually, it
somebody else
does.
is
So you have
paying
a, you
for it.
have a
We're all
market
paying for
making
it at the end. We're all
right,
paying taxes. Okay.
But it makes it cheaper because that market making investment gets you past the tipping point. Current estimates actually are that the U.S., as we cross that 5% new sales level, is starting to hit what analysts typically consider to be that tipping point. But the more we stimulate the production of the clean cars, right, the more you hit the economies of scale that makes them cheaper to produce in the first place, which means that you won't need as many subsidies in the future. That's why we believe in this policy.
So he says, yes, EVs might be more expensive by about $20,000 over regular cars, but it's a lot cheaper in the long run if you lease them or finance them. The guy's an absolute moron, an absolute amateur, has absolutely no clue how economics work. The other point, the fact that he's so out of touch, you have to experience more pain, that's good for us. What are these lunatics planning to do? Because his sponsors, the oligarchs pushing the green energy / EV lunacy, they're rushing to do it so fast to save the planet, quote unquote. They have no problem flying these private jets that produce more emissions than we will ever do, regular folks, to fly a 17 minutes flight, a 20 minutes flight, a 45 minutes flight, because God forbid they ever have to drive, be stuck in traffic with you, the bums, the subjects. God forbid they have to fly commercial with these people. I'll trust that these oligarchs really care about the planet once they start putting their money where their mouth is and fly commercial like the rest of us. But anyhow, the economic collapse is not just happening here in the US, it's happening across the globe. The global flash PMI is already in negative territory. That means a recession. Not just here, globally. The United Kingdom, for example, that economy is collapsing. It is one of the worst economies in the Western world right now. We'll look at different European economies, the Eurozone, France, Germany, all collapsing and dipping into negative territory, contraction territory. The manufacturing PMI. We'll look at different composite PMIs in France and Germany, services, manufacturing. All of them are dipping into negative territory. Is this an indicator for an upcoming boom in the economy or an upcoming disaster? On top of that, in Europe, it's not just that their economies are collapsing as they are right now. On top of that, there's a double whammy coming from the ECB because we have a massive stagflation phenomenon in Europe. You have economies slowing down tremendously in a recessionary-like fashion, while inflation continues to stick higher, which means the ECB have to increase interest rates higher. And this week, they increased interest rates by 0.5 point, the first time in 11 years. So you have two forces now crushing the European economy, the recession force / stagflation, then you have the ECB raising interest rates. Do you think the crash and the collapse of the European economy not going to have ripple impacts across the globe, which will impact us here in the United States? Think again. But I know we're supposed to be immune. We're the best economy in the world, the strongest, the biggest, yada, yada, yada. The BlackRock administration top propagandist, Brian Deese, says we have a historic labor market right now. We also have household balance sheets that continue to be strong. These are not the marks of an economy in a recession. Brian Deese says, what recession? Like he said, what inflation before, right? Transitory inflation. Now he says, I don't see the recession. We have a strong consumer here. How could you say that we're in a recession? Well, let me expose to you the myth of the so-called strong consumer. Brian Deese says households' balance sheets are absolutely phenomenal. We're not going to have a recession here. You mean this phenomenal, Brian Deese? Look at household savings rate, for example. Yes, it shot up higher during the pandemic, but now the savings rate is collapsing because inflation is eating away whatever savings households have. They have to spend more. Matter of fact, the personal savings rate in America just hit its lowest level since the Great Recession. Even as rates on saving accounts have risen. What gives? Question mark. What happens when the consumer is out of savings? They spent all of their savings, either on splurging in the economy and traveling or to cope with this inflation. The answer is ramping credit card using, swiping those credit cards up and down, up and down, up and down, with no end in sight. Here's the problem. While the consumer is resorting to use record highs amount of credit using these credit cards, buy now, pay later, whatever method they can find. Interest rates are moving higher, so your credit card interest rates will surge significantly higher. All of that debt that consumers are racking up on their credit cards, that's going to cost more to pay down. Here's the problem. It's not just that interest rates are moving significantly higher. And by the way, the interest rate on credit cards, the average, is around what, 18%, 20%? And that's moving higher and higher by the day. But it's not only that. What happens if the consumer racks up an insane amount of credit card debt, buy now, pay later, getting auto loans that they cannot really afford, getting mortgages that they cannot really afford, and then they lose their source of income. They lose their job because unemployment will move higher. This is exactly what the Fed wants to see in the economy because inflation will not go down without higher unemployment. You're seeing it happening in Ford. It's going to happen in many other companies. What happens if these consumers lose their jobs? How are they going to pay that debt back? Applications for U.S. state unemployment insurance rose for a third week to the highest since November as more companies announced job cuts, suggesting some softening in an otherwise solid labor market. And by the way, when they say solid labor market, they're referring to job openings, which by now you should realize that's a fake number. But again, what happens when the consumer lose their job and they have all that debt to finance? Here comes what? Here comes car repos. We talked about that. You're not going to be able to afford your car. We talked about Lucky Lopez a few videos ago, how consumers making $2,500 a month taking car loans that amount to more than half their monthly salary. Absolute insanity, risk-taking like we've never seen before in the auto market. On top of that, what happens to your mortgage when you lose your job? Well, you can't pay that anymore, and we are already seeing banks reporting rise in mortgage delinquencies. This is the strong consumer right here. When the media says, oh, this time around the housing market is not going to see any collapse like we've seen back in 06, 09, because the average credit score is much higher, where the credit score means shit. It means nothing. It's all about whether you have a source of income or not. A lot of folks assume that their inflated wages will be permanent, and they took mortgages they cannot really afford. What happens when they lose their jobs? Foreclosures. You know the story. On top of that, we got an absolutely stunning admission this week by AT&T CEO. Take a look.
We did the hard things we did in restructuring the business last year to give us the latitude and flexibility to do these types of things. And, then we've also seen a little bit of working capital issues as we've moved through it. There's clearly some dynamics going on in the economy where we have customers that are stretching out their payments a bit. We expect that they're going to continue to pay their bills, but they're taking longer to do it. That's not atypical in an economic cycle, and we're starting to see maybe the bottom end of the subscriber base making some decisions between, am I paying this bill this month or that bill this month, given some of the pressures they're seeing at home.
So now we have consumers who cannot even pay their phone bill. Is this what the strong consumer looks like? When consumers are now behind on their bills because they have to pay more at the gas pump, the grocery store, on rent. That's a major story. Nobody's paying attention to it right now. Rents are out of control. And oh, by the way, paying other utility bills that are out of control. And soon enough, you have to pay back your student loans. Uncle Joe's not going to cancel your student debts. The freezing of paying your student debt, well, Uncle Joe cannot even save himself, let alone save you. You're going to have to pay that back again. What happens when people start to lose their jobs? This is the question that every person in news media right now, financial news media, the Fed, all of these pumpers from banks and so-called analysts and economists have to bring out. What happens when consumers start to lose their jobs? You think they're going to buy iPhones and Teslas and splurge in the economy? Of course not. So what happened to these companies? What happens to the stocks of these companies? But I know what you're going to say. But Maverick, I don't believe what you're saying right here, because all I see when I go out is people splurging, dining out, traveling all over the place. Look at American Express, for example. The company reported earnings today, and here it is. Amex saw spending on its network soar as customers continued to take to the skies despite mass cancellations and long waits at the airports, lending the firm to raise its forecast to full-year revenue. In other words, people are using their credit cards, they're splurging, traveling in the economy. What are you talking about here, Maverick? Another one. The headline reads, inflation. Consumers spent 40% of monthly food budgets on restaurants. Is this a recession, Maverick? What are you talking about? Or are you just a perma bear? Here's what's going on in the economy, folks. I talked about this before in details. The recession is creeping its way higher in the income pyramid, hitting the poor, the lower middle class first, then hitting the middle class, the higher middle class, then the rich, and then finally the oligarchs when the economy collapses. What's going on in the economy right now? We have a recession in the poor and lower middle class. Why? Because they're paying more in rents, they're paying more at the gas pump, they're paying more at the grocery store, they're paying more in utility bills. They cannot splurge in the economy anymore. They can barely hold on. They are in a recession right now. They have no idea whether they're going to be able to pay rent or not. What's going to happen when they max their credit cards? For example, we got a warning from a company that caters to this demographic, Ross stores. Even though I shop at Ross sometimes because I like a bargain. But Ross came out and said that they're seeing demand collapsing all of a sudden. They're finding themselves with excess inventory, a same problem that we heard from Target, for example. And that demand suddenly disappeared because the consumer is facing a recession-like environment. We're talking about the poor and the lower middle class. Now, the mid class is facing stagflation. They have to cut down spending in certain areas because inflation is too high. So they have to budget and move things around. But they still have their jobs. Yes, they're paying more, but they're not spending more in the economy as they used to. And hence, they're not stimulating the economy. For now, the middle class is facing a stagflation phenomenon. Lower economic activities, lower spending in the economy, but prices inflation remains too high. Then you have the higher middle class. They're still facing inflation, but they're not facing a stagflation phenomenon right now for the most part, meaning they're not trimming down their spending to cope with inflation. Even though we have warning signs from stores such as Restoration Hardware, who came out and said the demand is moving down, and therefore the stock of RH went down big. But for now, think of the high middle class as, yeah, prices are high, it's inconvenient, we have to pay more, but it's not really lowering the standard of living or forcing them to make drastic changes in their behavior, specifically spending behavior. You see all of these spoiled brats, the 20-something crowd, who are hopping from one concert to the other, one music festival to the other, paying insane amounts for these tickets. Who do you think funding all of that? The answer is Daddy's credit card. But what happens when the Fed increases interest rates higher and Daddy has to pay more? Well, Daddy's not going to be happy. Daddy's going to say, you got to cut down. Ease it down. My stock portfolio's down. I'm losing money here. Maybe you should tone it down a little bit. And that's how it becomes a stagflation phenomenon. And then the next step would be a recession. Slowly but surely, recession moves its way higher. Then you got the rich, the same with the high middle class, who have tech jobs and they're secure for now. The rich relies on what? Relies on stocks, real estate valuations. These are not down enough, specifically real estate. So yes, they might be facing inflation for now, paying more for goods and services, but inflation kind of helps them out too, because they charge more for rent. This is the owner class. Yet they're not going to be immune when the recession moves its way higher. And lastly, you got the oligarchs, the 1%, the Bezos, the Musks of the world. They're enjoying an economic boom. It's never been this good before. And when the recession hits them, when the crash happens, real estate valuations crash, stocks crash, everything crashes, we get to bail them out because they're too big to fail. So for them, it's always an economic boom. Why? Because we have an economic system that we think of as capitalism, but in reality, it is an oligarchy. Now, here's a few stories that illustrates for you what I just said. We talked about the affluent consumer spending 40% on restaurants. We talked about them using Amex cards, hopping from one music festival to the other with Daddy's credit card. But what about the poor and the lower middle class who are already in a recession? And they're looking up and they're saying, hey, middle class, higher middle class, rich, you better watch out. What we're facing right now is about to hit you too. The headline reads, after inflation, people making U.S. minimum wage are earning less now than 60 years ago. The standard of living has never been worse. For most people, most of them were not alive back in 60 years ago. Another one. The headline reads, inflation, consumers are reacting to high food prices, said grocer. What are they talking about? This is a small grocery store owner. He says, we're not Walmart. In turn, his purchasing manager pushed back against higher prices from suppliers. We advocate for our customers, said Davidson. This is the guy. We're not Walmart, we're not Target, he said, but when someone calls and says, hey, I'm going to raise your costs 20% to cover my commodity piece, my comment back to that supplier is, hey, if we put that retail in your product, it will sit there and no one is going to buy it. The consumer cannot afford it. Another one. The headline reads, swelling grocery bills are plummeting the poorest, who spend over a quarter of their incomes on food. An estimated 38 million Americans are food insecure, meaning that they have insufficient means to obtain sufficient food. The concern is, with food inflation rising at the rate it is, more families will face the prospect of being unsure where their next meal is coming from. Wow, this is in the richest country in the world, folks. Why? Because look at this. A loaf of bread now costs $10. We're talking about bread here. You go ahead and look back in history. What happens when people cannot afford bread, a loaf of bread? What happens under these conditions? We're talking about unrest. We're talking about riots, revolutions, wars. But you got Marie Antoinette, the transportation secretary, saying, hey, this is actually good because it will force you to buy an EV that you cannot even afford. But here it is, folks. Next time you hear somebody says, oh, but the strong consumer, how could you say that we're in a recession? Now you know how to explain that. It's coming. It's hitting the poor, the lower middle class right now. It's going to creep its way little by little higher to the middle class, to the upper middle class, the rich, to the oligarchs. And then it's going to hit the entire economy. And guess how they're going to fix it? More trickle down. Let's bail out the oligarchs, the companies, because they create jobs. This is the rigged system that we have. Anyhow, the rant is over now. Let's move on to cover the stock market information for you. I'm going to start with the closing of the indices today, and here we go. The Dow Industrial Average closed down by 137.61 points, or a loss of 0.43%. The Nasdaq down in the red, losing 225.5 points, or a decline of 1.87%. The S&P 500 also down by 37.32 points, or a decline of 0.93%. What about the sector's performances today? Coming up at number 1, capturing the gold, the silver, and the bronze. Utilities. Don't count utilities dead, at least not for now. The rest, we have consumer defensives and real estate in the green barely, so we're not going to give medals there. But the laggards of the day led by communication services, the obvious Snapchat, dragged down Meta and Google, but we also have technology and cyclicals. So today was a defensive theme opposite to the main theme for the week, which was offensive. And here it is, the contrast. The performance for the week, coming up number 1, capturing the gold medal, cyclicals. Number 2 for the silver, industrials. Number 3 for the bronze, technology. Meanwhile, the laggards for the week, well, pretty much every sector was in the green with exception of communication services. The majority of the losses came today due to the obvious Snapchat, Meta, Google all down. And what about the advance to decline ratios? NYSE 30% advancing versus 66% declining. The Nasdaq 22% advancing versus 73% declining. Awful breadth for the last day of the week. Commodities, what's going on here? Mixed picture in crude. We have the WTI down by a little over 1.25%. Then we have Brent pretty much mute for the day, not doing anything at all, be it closing slightly negative. And then we have the RBOB gasoline gaining a little over 2.25% for the day. On the other hand, heating oil down by about 3%. And here it is, the party boy, natural gas, gaining about 5% for the day. Natural gas is climbing higher rapidly. This is going to be a major problem for the Fed because it pushes inflation higher. Now let's cover some energy news. The headwind that we have for natural gas is the Freeport LNG facility. It acts as a headwind or a tailwind depends on the good news or the bad news. Good news from Freeport LNG means bad news for natural gas prices. Bad news from the Freeport LNG facility means good news for natural gas prices. Well, this week we got some good news from Freeport LNG. The headline reads, small amounts of natural gas flowing to Freeport LNG plant in Texas. The company has long said it does not expect the plant to return to partial service until October, but was not immediately available to explain the small amount of feed gas going to the plant. So we have a mystery here. What's going on? Are they testing by a little bit? Once that news came out, natural gas went down. That was on Thursday. And then it rebounded higher today because we continue to have supply problems over in Europe. Russia's playing games. Putin is playing games. He says that the flow of gas from Nord Stream 1 to Germany is back in order, but with conditions. Now, do we know whether the Germans agreed to these conditions or not? Well, we have no idea, which means that the restart of flows from Nord Stream 1 should not be taken for granted. At least for now. Then Putin comes out and says we're yet to see the quality of returned Nord Stream 1 equipment from Canada. So all of a sudden now it's about the quality of the equipment. We have to wait and see. This is all done to inflict more pain on Germany. In the meantime, Europe is ready to outbid the rest of the world for natural gas in the race to secure the winter supply. So Europe is willing to pay top dollar here. Where is the supplier, you might ask? Well, it's not going to be Russia. They cannot do it from Algeria or Egypt or Qatar. That's not an option, at least not for now. So the answer is US LNG. And therefore, we're seeing natural gas futures here in the U.S. shooting up higher again, which means these natural gas stocks will be hot again. We're talking about Coterra, we're talking about EOG, we're talking about EQT, Cheniere. We have a lot of names here that will continue to gain because this story is not over yet. Back to the futures, what about softs? We have declines, big ones, led by lumber. Lumber was down over 6% today, now trading at the 500s. We also have declines, big ones, for coffee, losing over 4.5% today. Likewise, sugar is not acting sweet. It is down over 2.5% today. Then we have modest declines for cocoa and cotton futures under 1%. Meanwhile, OJ futures were flattish for the day. Metals, mixed picture. We have gains for gold, but declines for silver. I don't know what to make of that, but we have gains for platinum, copper, and palladium. Palladium shot up higher by more than 8% today. The dollar is down. This should be good for gold and metals in general, but the question is, how sustainable is the drop in the US dollar? Because if the dollar rebounds higher again, we will see gold, silver, copper all moving down again. What about meats? We have massive gains for both live and feeder cattle futures. Feeder cattle futures adding gains of almost 2% today. These two are still winners year to date. Then we have lean hogs. Lean hogs also gained about 1.5% today, but what do you see here? It says down over 17%. That's wrong. They're actually updating the contract from the August contract, which was trading at around $117, to the October contract, which is at around $96. So they're just updating the contract. It's not because lean hogs futures crashed overnight. And then we have grains. What's going on here? We have a decent rebound in soybean oil futures, gaining a little over 2.75% today. Likewise, a rebound in soybeans futures, gaining a little over half a percentage point today. We have canola closing in the green with gains of almost 1%. On the other hand, we have declines for soybean meal, rough rice futures, all declining modestly, but we have big declines. Corn, for example, is down over 2.25% today, but the story comes from oats and wheat. Oats down by almost 8% today, along with wheat, which was down over 6% today. And the question is the inflation in wheat over? The answer is perhaps, because wheat futures are trading below the pre-war levels. And the good news that we got today, good news, by the way, means bad news for wheat futures, but the good news is that we have a deal between Russia and Ukraine to allow exports of grain to get out of ports. This was good news, and it pushed wheat and oats futures down. Not so much for corn, and it doesn't really solve the problem in the long run, meaning if this war prolongs, we're still going to have a shortage of wheat, even as is for this season. Ukrainian farmers did not produce enough wheat. A lot of the farmland is damaged. A lot of farmers did not seed for the next season, so we're still going to have a shortage in wheat, and this will put a floor on the drop in wheat, meaning we're going to see futures rebounding sooner or later. But for now, wheat futures are reacting to this piece of good news. Moving on to the options market, the big casino, what's going on here? The volume went higher significantly, but they're not buying a lot of calls. The put to call ratio remains kind of split in the middle. We're actually seeing a lot of folks buying puts, betting against the rebound. Regardless, at number one, the hottest table in the casino today was Tesla, the souffle, at around 2.2 million contracts traded today. About 55.5% of those were calls. At number two, Snapchat, at around 1.2 million contracts traded for the name. About 58% of those were calls. Number three, Apple, at around 1.2 million contracts traded today. About 52% of those were calls. What about the unusual activities that took place in the options market today? We start with the ticker SNAP, Snapchat. Somebody's bidding for a rebound here. They bought the $11 calls for the expiration date, August 19th, with expectations that despite the fact that the name is down over 38% today, we will see a rebound of over 11% by the expiration date, August 19th. They paid around 55 cents a piece to enter this trade, all in all spending around $770,000. Then what about the trade for the ticker COOP for Mr. Cooper? This is a real estate company, single family homes. They handle mortgages and all of that. Somebody's making a big bet here. betting against the name. Now, this is an unusual name. We don't see it often here, meaning this is perhaps an insider who probably knows something that we don't know. And they bet against the name by buying the 36 puts for the expiration date, August 19th, with expectations that the name could move down, losing more than 11% by then. They paid around $1.20 apiece to enter this trade, all in all spending around $1.2 million. What about the trade for the ticker GME, GameStop? The name split today. They could not wait for it to split organically, so they split the name. And guess what? GameStop was down big today. But somebody's bidding for a rebound here. They bought the $40 calls for the expiration date, July 29th, meaning next Friday, with expectations that the name could rebound higher and gain more than 12% by then. They paid around 75 cents apiece to enter this trade, all in all spending around $675,000. And lastly, we have the ticker SNOW Snowflake. Somebody's making a major bet here against the name. They bought the 130 puts for the expiration date, September 16th, with expectations that the name could move down by more than 9% by then. They paid around $11 apiece to enter this trade, all in all spending around $10 million. Moving on to the heat map analysis, what's going on here? We're seeing the opposite picture for the week. Throughout the week, they've been buying the risk-on kind of stocks: technology, chips, software, cyclicals, communication services, biotech, and they've been dumping the ultra-defensives in utilities, REITs, big pharma, consumer staples. Today, we're seeing the opposite. They went back to the defensives, at least for now. For today, we saw big pharma outperforming, we saw utilities outperforming by a lot, and keep your eyes on utilities, specifically the XLU, because the dips in that name will be opportunities to buy. Maybe not right away. If we have the summer rally will be led by tech and the risk-on kind of stocks, and we will see utilities being dumped. However, it's not if, but when we go back to risk-off, they're going to buy utilities once again. Along with utilities, we got real estate also outperforming, along with consumer defensives, the consumer brands, mostly in the green, led by Procter & Gamble, gaining over 1.5% today. On the other hand, the losers were led by big cap technology stocks. Apple, Microsoft, Google, Meta, Amazon. Tesla is a different story because they got earnings. We have a short/gamma squeeze in Tesla. But software was down today. Chips were down. Nvidia lost over 4% today. Banks were down. Biotech was down. Today was defensive in nature. Now let's contrast this with the weekly theme. And here it is. Big pharma down, gold down, utilities muted, real estate lagging, the consumer staples down for the week. And what's working? The big caps, with exception of Google, of course, because Google lost a lot today. But Microsoft, Amazon, Tesla, software, chips, all gained significantly for the week. The reopening names, casinos, airlines, cruises, hotels, all winners for the week. Even in industrials, in materials and energy, the inflationary/commodity trade was hot, but even within industrials, look at the winners year to date. The defense contractors, LMT, NOC, Northrop, all lagged for the week. This is perhaps because Lockheed reported earnings, but again, the theme for the week was risk on. Dump the winners year to date and stick with the losers. Buy the dip in RKK, Apple, Microsoft, software, etc. Will that last or not? Well, that depends on how the Fed is going to react next week. Is it just going to stick to the 75 basis points hikes, and then it disappears for August, comes back in September with another perhaps 50 or even 25 basis points hike? That will initiate a summer rally, which will be led by the names lining up in green in the map right now. Otherwise, if we have the Fed being a little more aggressive right now, front-loading these interest rate hikes by going 100 and then saying maybe an emergency meeting in August, then you will see the market going back to utilities, big pharma, consumer staples, the ultra-defensive sectors of the stock market. What about the weekly heat map for the ETFs? Again, the risk-on, XLY, consumer cyclicals, chips, the SMH, technology, XLK, retail, XRT, even home builders, XHB was higher, on the 10-year being down, at least for now. But it wasn't just the growthier sectors that outperformed today. The contrast between growth and value was slim. Even value sectors such as energy ETFs managed to outperform the XOP, XLE, OIH. Real estate, the IYR, was up almost 3% for the week. The weakness is coming from the ultra-defensives and the XLU, XLP, consumer staples and utilities. And then we have the XBY lagging for the week. That's because the XBY got a little ahead of itself last week. When we talk about internationals, all in the green, but the laggers being China, a proxy for growth, and the EWZ, a proxy for inflation/commodities, not giving us a clear direction one way or the other. For now, when we see everything is higher for the week for the most part, with very little contrast between growth and value, you know that this is a bear market rally. Is it going to sustain or not? That depends on the Fed next week, whether we have a summer rally or not. But pay attention to another ETF here, the EMB in fixed income. This is the JP Morgan Global Fixed Income Bond ETF, which was up big for the week, gaining almost 4%. Here's the problem. Look at the chart of the EMB. This is a weekly chart. It is reading below the pandemic low in 2020. Is this a good sign for the economy? Of course not. This is a sign that a recession is coming. But Maverick, it's rebounding higher. It's moving higher again. Isn't this a good sign that the recession is over? Of course not. This is all a deja vu of 2008, folks. Let's go back to 2008. Same chart, EMB, weekly chart. The chart crashed in a signal the recession is coming. And then it caught a bottom and rebounded higher in October 2008. Now ask yourself a question. Was that the bottom in the stock market? Of course not. Was that the bottom in the economy? Of course not. We got hit with a recession right after. So why did the EMB move higher back then? The answer is the rush to safety. Global bonds were more attractive back then. So what are you seeing right now? A rebound, if it lasts, even here in the U.S. bond market, the TLT, if they start to move higher, that would be a sign that we have a rush to safety and the recession is coming. So this is one thing you got to keep an eye on. Speaking of, let's move on to the charts analysis. When we start with SPY, the S&P 500, 30 minutes chart, what's going on here? Last time we talked about the triangular consolidation pattern. And I told you my bet is it's going to be broken to the downside. The question is, will the dip buyers show up or not? Well, we have the answer. We got the breakdown, but the dip buyers showed up right away on Thursday, buying the dip, and they did not stop till the end of the day. And they got the chart all the way to the next resistance at around 398. Here's the problem. Today we got the pullback all the way down to the support of 393.16. And then we got a little rebound by the end of the day. Is it going to last? Is it not going to last? Well, here's what the bears are looking at. The bears would argue this is the beginning of a head and shoulder formation. We got the left, right shoulder, whatever you want to call it. We got the head. Now we're forming the next shoulder. And soon enough, the chart will lose this support of 393.16. And it's going to head down all the way to the next support of 385 and perhaps all the way down to close some of these gaps. The bulls are going to argue, wait a minute here. If we remove all of these markings, we have a trend line. Yes, it is steep, but it is a bullish trend line, and the chart is rebounding from the same trend line. Who has the better argument, you might ask? I say the bears, because this is a steep trend line. The chart has to stall at some point, and it is stalling right now, meaning which one is more likely to play? A rebound from this trend line and we continue to shoot up higher, or do we see the head and shoulder formation playing out? I say the bears have the better argument now. Maybe Papa Jerome will come to save the bulls midweek, but for now, the bears have the better argument. What about the daily chart for the continuous contract for the SPY? The good news is the chart closed above 3,960 for the week, which is a major win for the bulls. Can they keep that next week or not? That remains to be seen. It's going to take a lot to see damage in this pattern. It's going to take a lot for the bears to become emboldened again. What do we mean by a lot? It means a loss of the support 3,855, number one. Number two, making a lower low in this pattern, which means losing the support of 3,720.5. It's a long way from here. It could happen, but it's going to take a lot of disappointment from earnings. And then comes the question, will Papa Jerome rescue the stock market and induce a rebound? We'll see. Lots of action is about to happen next week. But for now, we have some worrying signs, such as the volume moving higher on a down day on Friday, and the 30 minutes chart showing a head and shoulder potential. But for now, from this chart, the daily chart, and the SPY, the continuous contract, the bulls still have the advantage for now. Keyword, for now. And what about the SPX, the cash index? Look at what happened here. We talked before that these gap above will be closed. Well, guess what? We closed both of them on the SPX. But now the chart is pulling back after closing the gap. Now we have a pattern of higher lows. Can the chart keep the higher lows pattern, or is it going to violate that? Was the rebound just an algorithmic rebound to close the gaps and that's it? And then we go down forming a lower low? That would be a disappointment for the bulls, because the bulls would say, well, the downtrend is over. The series of lower highs, that's over now. We have a higher high. So at least, at a minimum, we should catch a summer rally. This is what the bulls are hoping for. It all depends on earnings, the Fed, or whether this chart moves higher, above the gap. What about the Qs, the NASDAQ, 30 minutes chart? What's going on here? We talked about, last time we talked about the double top, which got us a pullback, the red candle that you see, but immediately on Thursday, the dip buyers showed up and they got the chart to move higher all the way to the next resistance in yellow, and today pulled back. All the way back where? The same range from Wednesday. So very little damage happened to the chart right now. But if you're asking where is this resistance came from in yellow, we have to zoom out and it goes all the way back to a gap at around 307.41. Now, the bears would argue, if we clean up the chart and we go back to the pattern that we have for the week, the bears are going to argue that this is a formation of head and shoulder. The chart's going to form the last shoulder, and then it's going to flush down to close these gaps below, meaning the rebound is over for now. But the bulls are going to say, hey, not so fast. Let's bring back all of these indicators and markings. The chart went back to the same support from Wednesday. Not a big deal here. And it's going to rebound higher and crack above that resistance next week. We'll see who's going to win, but for now, it appears that the bears have the better argument, at least looking at this chart, the 30 minutes chart. Before we move on to the continuous contract, here's a daily chart for the Qs, the actual Qs, triple Qs. Look at this. We have a pattern, a curved pattern of lower highs. And we hit that pattern exactly. We pulled back on Friday, today. Is this it? Are we going to go down, forming another lower low? Or is the chart going to break above this pattern? This is what the bulls are hoping for, because the bulls would argue we're making a pattern of higher lows, which we have not seen before. Meaning, yes, maybe we got a pullback today, gathering some energy, but this chart will pop above this negative pattern by next week. Here's the daily chart for the continuous contract, the NASDAQ. The good news is, yes, the chart did not make it above 12,766 by the end of the week, but it kept 12,207 intact as support by the end of the week. This is a win for the bulls, no doubt about it, but the bears are starting to smell some weakness here. They're looking at the volume moving higher on a down day. They're looking at the chart stalling, the momentum indicators perhaps running out of gas, but the bears are not going to be excited until two things happen. Number one, the chart loses the support of 12,207. That's number one. Number two, the chart makes a lower low pattern. This is not going to happen without losing the support of 11,689. So it's a long way from here. The bulls will have enough time to realize that the bounce is over, if that is indeed the case. But for now, the bulls have the advantage on the daily chart. What about the IWM 30 minutes chart for the Russell 2000? What's going on here? It is trading within range, the support 178.60 and the resistance that we got today, but it actually goes way back. If we zoom out, it goes back to a gap that we got at around 182.81. But the bottom line is the chart remains within a range. It has negative divergence on the RSI, meaning weakness, meaning the bears have the better argument here that the chart will go down to the next support of 174.22, maybe closing some gaps below. But we're not going to say that for sure till the support of 178.60 is gone. Now, when we look at the weekly chart for the IWM, two numbers are really important. The first number is 163.62. What is that number? That's the gap below, which was closed, and the chart rebounded from that point on. The next number is 178.59. That is the gap above, which the chart closed today. So what happens now? Does the chart continues on this pattern of moving higher? The worst is behind us. The negative pattern has been broken of lower highs. Or does the chart says mission accomplished, we closed the gap below and above, and now down we go? For now, for the weekly chart, the bulls have the advantage. What about the Dixie, the dollar index? Yes, it pulled back, but who's to say that this is not a bull flag consolidation pattern? And sooner or later, the dollar is going to move higher again. If it does, say goodbye to the rebound. So the dollar is the most important chart here. But we have a development that says perhaps this is a legit top for the dollar. It's going to go down further. And this is coming from gold. Here's the daily chart for gold. It managed to rebound from the very important support of 1,685. It is keeping that as support for now. So far, so good. The RSI, the MACD, the momentum indicators are extremely oversold, and they're reacting to these conditions by rebounding. Now, can we see a follow-up next week? Well, that depends on what the dollar is going to do. And that depends on what the Fed is going to do. See how this works? It's It's all about the Fed. What about crude? Brent, 4 hours chart, what's going on here? It is having a hard time passing 105.84. This is the resistance for now. It is still consolidating in a positive pattern, bullish pattern, which means the pop should come higher, but there's a problem. We have negative divergence on the RSI, indicating weakness. But it's not over until it's over. What does that mean? It's not over until the chart loses 99 as support. Then we say this is over. We have lower lows to come in the chart of Brent. Now, what about the daily chart for the 10-year yield? What's going on here? It is moving down, and it got all the way close to my number of 2.72. Can we see a rebound next week, or is this it? Is this the top in the 10-year, and down we go? If that is the case, if down we go, we're going down for the wrong reasons, meaning a recession is around the corner. If we go higher, we're also going higher for the wrong reasons, meaning the Fed will increase interest rates even higher, and inflation remains a problem. So the best case scenario right now for the bulls, market bulls, is consolidation. No rapid moves, impulsive moves, one way or the other. But what does it look like right now? It looks closer to a head and shoulder formation, meaning we could see break below 2.72 as support. But that also depends on what the Fed is going to do next week. But here it is, the TLT weekly chart, closing green for the week. A big pop today. The momentum indicators are curling higher. Now, some technicians would say the TLT is moving higher, 10 years moving down. That means we should buy the NASDAQ, because this is good news for equities. The problem is the 10-year yield moving down for the good or the bad reasons? Is the TLT moving higher for the good or the bad reasons? What am I talking about? Is the TLT moving higher because inflation worries are gone now? Or is the TLT moving higher because we're seeing rush to safety, because we have a recession around the corner? If it is the latter, then it should be bad news for the NASDAQ and equities. What about the VIX 4 hours chart? What's going on here? It lost the most important support of 24.29, but the momentum indicators are getting oversold. Not by a lot, but we're starting to see oversold conditions, oversold readings, meaning the VIX could pop higher. And if it does that, let's say early next week, and it recaptures 24.29 as support, we see a pullback in the SPY. Maybe bad news about earnings. Can the Fed come out on Wednesday and reverse that picture? Another way to look at it, can we see the SPY building on the gains, and we see the VIX flushing down from Monday, Tuesday, all the way back to 20, and then the Fed comes out, it scares the market, and we see 180, the VIX rebounding from 20, and then the SPY flushing down from the next resistance. Something to think about. Think about the Fed as the counter trend for whatever happens on Monday and Tuesday. The VXN, the VIX for the NASDAQ, what's going on here? The bear flag played out. It did not get the chart down closer to the support of 27.5, but we're starting to see oversold conditions on both the RSI and the MACD, meaning we could see a 180, a pop higher in the VXN. What would be the catalyst? Is it going to be catalyst of earnings, or is it going to be the catalyst of the Fed? Which one is stickier and more important? I think it's the Fed, not earnings, because we can have an earnings scare, stocks flush down, the VXN pops higher, then comes the Fed, says, you know what, enough damage is done, we're doing the 75 and then we're done. Then you'll see the VXN flushing down and the NASDAQ moving higher again. But perhaps this will be the most important chart next week. It is Apple, a daily chart. What's going on here? It stopped and pulled back exactly from the resistance that I identified for you, the trend line in yellow. Now it becomes an earnings game. If Apple disappoints, it's going to go down, losing 150 as support, maybe 145, and the market will be upset. And in all likelihood, Apple will go down to make lower lows. But if Apple delivers, whatever delivers mean, we will see it moving higher above the next resistance at around 157, and here comes the summer rally. Now, even if we have a summer rally and the Fed is out of the way, do we really believe that Apple will go back to the former highs? When we have a weakening consumer, a slowdown in China, etc., European economy about to collapse? Which one is a more reasonable argument? Apple going back to the former highs at around 182, or Apple going down, making a lower low all the way to the support of 127? I would say the latter one is more reasonable. What about Tesla, the souffle, 30 minutes chart? What's going on here? Tesla was supposed to give us the reaction next week, but it decided to give us the reaction right away, and it was a massive pop higher. The question is why? The answer, we have a lot of folks who short ahead of earnings. They assume that the China factories were down, hence we will see a bad number for Tesla, the stock will crash. I gotta get ahead of it. I gotta short before earnings. I gotta buy puts before earnings. Well, guess what? The slowdown in China doesn't show up in this report. All of a sudden, the shorts have to scramble and cover their puts, their short positions, and we see this massive pop higher. And then another thing happened. As the stock was moving higher and it got closer to 800, guess what happened? A gamma squeeze. because there were a lot of call options buying the 800 calls. There were a lot of open interest in the 800 calls. So the market maker got caught with their pants down. When the stock moved higher based on the short squeeze, the initial short squeeze, the market maker said, you know what? These 800 calls will be in the money if this continues. So I got to buy shares too. So now you have the shorts and the market maker buying Tesla shares together. And this is the reason behind the massive pop that we got after earnings. Now, the sustainability of the pop depends on if we have a follow-up or not. Do we have organic buyers, mom and pops, institutionals waiting on the sidelines saying, you know what, Tesla's not going to get any cheaper. This is a dip to buy because the stock will be back at 1,000 in no time, be back at 1,500, go to 2,000, whatever. If they follow up and they buy, we will see higher highs. The daily chart, the weekly chart kind of support that, but there's a problem. If they don't show up, then the sellers will. They will look at this as an opportunity to get out at a better price, and Tesla will move down. What supports that is the monthly chart, the most important one. What am I talking about? Here's the weekly chart for Tesla. The most important number is 700. For now, the chart is above 700, and we have a negative pattern of lower highs. Is this pattern about to be broken? Look at the RSI, the MACD indicators. They're suggesting yes. We could see a pop higher, and that pop higher could go all the way to the top of the breakdown candle, which happens to be at around 979. That will be a massive gain from this point on, but here's the problem. Even if that happens, the monthly chart remains negative, and it's going to form a head and shoulder pattern. This pattern will produce a crash. This crash could be happening in the fourth quarter of this year, could be happening in the first quarter in 2023. The bottom line is, whatever summer rally we get from Tesla, if it happens to begin with, will be an opportunity to sell because the monthly chart remains negative. If the monthly chart changes, that's a different story, but it's hard to see. With this inflationary environment, with a recession coming, with unemployment about to move higher, the bear argument is a stronger one right now. Bitcoin, BTC, what's going on here? An hourly chart, we had a pattern of higher lows. That pattern is broken now, and we're making lower highs. Now, does this mean that the run in Bitcoin is over? The rebound is over? No, but it means that the run is running out of gas. It is stalling for now. What does that mean? We see the profit takers, the ones who bought a 19,000, the ones who bought a 20,000, taking profits. That gives a dip opportunity for those waiting on the sidelines to hop in and buy. If that happens, Bitcoin moves higher again, forming perhaps another pattern of higher lows and higher highs. But if the buyers don't show up from the sidelines, the sellers will, and they will take that chart down all the way to 20,000. If that support's lost, forget about it. We have lower lows to come in Bitcoin. If Bitcoin goes down, so will the NASDAQ and the risk on in the stock market. And lastly, we have the viewer says, cover AMC, you coward. Okay, here's AMC for you. 2 hours chart. Last time we talked about this chart was a pattern of higher highs and higher lows. The most important resistance was 14.24. Well, guess what? The chart made a lower high. That was the end of that. And then came consolidation for a few days, a few weeks, waiting and waiting and waiting. What's going to happen next? Does the chart make lower lows or does it make higher highs? That depends whether the buyers are going to show up or not. Well, guess what? The buyers did show up and they got a little bit of resistance at around 14.24. They tried once, they tried twice. Third time was a charm, a break above 14.24. And here comes the pattern of higher highs and higher lows. That pattern was broken yesterday, or today I should say. This is being recorded on Friday night. You might get it on Saturday, but it is Friday night here. And by the way, we got the sign that this is running out of gas and it's about to reverse because on the 2 hours chart, we got negative divergence on the RSI. On the 30 minutes chart, it got really, really overbought, overextended on the RSI. Now, when that happens, I have to take a shot, and I did yesterday. On Thursday, I did buy the 17 puts. This is a long shot kind of trade, by the way, so I don't spend a lot of money on them, but I bought the 17 bucks puts, and I paid around 25 cents a piece to enter this trade. And today I dumped all of those for $1 a piece, so I made about 300% gains. Now I wish that I put more money into it, but the discipline says if you're opening trades with 1 day till expiration, these are wild shot kind of trades. You don't want to put a lot of money in them. A few $100. If you have a larger account, maybe you can afford a few $1,000 in them, but that's about it. Because if you're wrong, you lose all your money. So a better way to do it is to buy longer expiration. But I'm not into AMC up or down. It's not a chart that I'm following anymore. But when I saw the overbought conditions, I had to do it in a wild shot kind of trade with 1 day till expiration. Either it happens or it doesn't. And it did happen. It was a good score. And that's that. Now, where does the chart go from here? It depends whether the chart is going to violate 14.24. This appears to be likely, but it all depends on the Fed. This is a company with a lot of debt on the balance sheet. If the Fed backs off, it does 75 basis points, and then it says, okay, we're done here, you will see AMC shooting up higher. But if it doesn't, if it does 100 basis points, or it says perhaps even more, then we got a problem, and AMC goes down. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar next week? On Monday, July 25th, we have the Chicago Fed National Activity Index. Tuesday, 26th, we have the S&P Case-Shiller Home Index. Very important, but it is a lagging indicator for May. Then we have the Consumer Confidence Index, and we have new home sales. Wednesday, the most important day for the week, the 27th, we have durable goods. We also have pending home sales, but most importantly, we have the Fed meeting and the conference by Jerome Powell. Thursday, the 28th, we have GDP data. We have, per usual, the initial jobless claims for the week. Lastly, on Friday, the 29th, we have PCE core inflation, another important indicator for the Fed at least. Then we have real disposable income, real consumer spending. We have the Chicago PMI. We have the employment cost index. And we have the final reading, the University of Michigan Consumer Sentiment Index. Now, for upcoming earnings, you gotta wait and watch my earnings reviews plus previews video, which will be out by Sunday. And with that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow. Enjoy the weekend.